There's also something called a 1031 exchange, right? So if you have a house with a lot of equity in it, you may know about this. You can sell this and buy another house, another property, and then defer the tax gains. But typically, what that does is it forces you to become an active investor. So you could sell that whatever house and buy something else, but you now own that house. But what we do, for example, in Nighthawk, we allow you to 1031 exchange into a syndication, which is really cool. It's a little more complicated, but we've done it several times now, and it's a way for you to actually defer your taxes from whatever house you have. And then on the back end, if you want to, you can 1031 exchange into another property if we have one. And this really allows you to defer taxes if you keep playing the game in perpetuity. So welcome to today's webinar. It's really, we're going to talk about Syndications 101. If you're new to investing passively into syndications, or you want to learn more about syndications, this is the place to be today. And we'll get we'll do some more advanced stuff as well. But we really want to talk about kind of what are syndications, what's passive investing versus active investing. And then more importantly, once we cover that, which we should be able to do pretty quickly, we'll talk about the really more important thing is how do you do diligence on a sponsor, an operator, or even a deal? Like what should you be looking for as you're evaluating real estate syndications? So we're going to talk through that here as well, and then we'll do a live Q&A at the end. So make sure you have your questions. And if you have questions here, we'll have the chat on. Just let us know in the Q&A, and we'll pick those out here just here in a little bit. So let's start first by what is a syndication? It's kind of like a fancy term for partnering between passive investors who are they're known as limited partners or LPs, and active investors, also known as general partners or GPs, right? It really, syndications allows you, people with money to invest typically in the stock market now, to invest in large multi-million-dollar properties with smaller amounts. And the larger the properties are, these larger apartment buildings, the more economies of scale there are. They're managed by better property managers, and they really now become less risky and more profitable. And that's really the benefit. The other benefit, of course, is that you don't have to do any of the work, and that's what the general partners do. That's what Garrett and I and Drew do at Nighthawk Equity. We are your general partners, your operators. They're doing all the heavy lifting, and this is a great partnership, right? Because you're putting up all the money, you're getting a percentage of the deal, and then the general partners are doing all the work, and they also get a percentage of the deal. And so the limited partners get a return on their money, typically 15 to 20% average annual return, which is better than the stock market. And also you're getting cash flow. And typically, unless you do some very advanced options trading, the stock market typically doesn't provide cash flow, and you get that with investing in real estate, and you get tax benefits that you don't get stock market or other kinds of investing. So it works out great, and the general partners are doing the work. They have all the liability so that you don't have those things. So it's a great way to get started investing in real estate. And so with kind of that out of the way, Garrett, what kind of thoughts do you have in general about the partnership between LPs and GPs?
Yeah, so listen, we have people all the time that are reaching out to us that maybe they own a couple of houses, or they've done some flips, or they've done something in real estate, because residential is just the easiest way in. Let's be honest. Most everyone out there has bought a house at some point. They understand the process. They understand how to get into real estate. It makes sense for them to go try to get these rentals or buy a couple rentals because they bought a house. So easy transfer of skills. The problem that they find is when they get into those rentals and they start renting them to other people, that they've got a whole list of headaches that they don't want to deal with. And so the product that we offer and that other operators out there offer is, hey, you can get into something that's a little bit more solid than just a single rental. Because remember, if that person moves out, you're out of income. You can get into something that's got 100 of those or 200 of those rentals in one property and invest into that and not have to do any of the work. It's really the only way that I know that you can really, truly passively invest into real estate. Now you have to give up something for that. We don't work for free. No one else out there that's doing this is going to work for free. But is it worth the trade-off for not having any of those headaches with the rentals, having to deal with dispositions, the acquisitions? There's a lot of things that goes into it. And so we built an entire business around doing all the hard work so that the LPs don't have to do the hard work. And it really creates this amazing relationship where you get checks sent to your doorstep or ACHs every quarter. You get quarterly reports virtually, and you don't have to deal with the headaches of tenants, toilets, maintenance, any of the crap that comes with owning real estate.
Yeah, that's a good point, and I think a good number of our investors we see attract obviously high net worth individuals, but they typically have rentals, and that's how they get into real estate. Garrett is exactly right, and so and the problem with rentals is, as you know, first of all, they don't produce a lot of money. That's the most irritating part, and then on top of that, it actually is actually work. And so this now allows you to invest passively in real estate that is actually quite lucrative without having to do the work. And so it's pretty cool from that perspective as well. Now, some people ask Garrett, what about like investing in a REIT? If I invest in a REIT, is that not like investing in like a syndication?
It's different. You're not going to get the same benefits as investing into a syndication. When you're investing in a syndication, you're actually a co-owner of the property alongside the general partners. Whereas in a REIT, you're just investing into it's almost like a stock in a way, but it's full real estate. So you don't really get the same benefits by investing into a REIT. It's a completely different profile.
Yeah. I'm curious from the audience here. I'd like you to type in the chat why you're looking into alternative investments. In other words, what is wrong with the stock market? Why don't you just invest in the stock market? Like, I'd like to see in the chat right now why you're even on this call and what attracts you to alternative investments in general, and then real estate specifically. So Misael is saying looking for diversification, but what is specifically what do you want different than the stock market? That's kind of what I'm looking for. Is why not just keep investing in the stock market? You're here because you're looking for ways to invest outside the stock market. Some of you are maybe even looking at other asset classes like oil and gas, for example, or maybe precious metals. Tori's saying higher return and less risk. Okay, yeah, that's good. Ben is saying a safer investment. Evan is saying higher return cash flow. Those are good reasons. Tax advantages, is that a reason for you at all? Getting into real estate? What are some of the other reasons you're looking outside the stock market? Those are some good reasons. And so I'm not saying stocks are bad. Stocks should be part of your portfolio. But I think what Garrett and I think, and we do personally, is that it shouldn't be the only thing in your portfolio because they do different things, right? Because real estate has a typically above average returns. Like I said, 15 to 20% average annual return when the stock market is simply about 10 or 12, and provides cash flow and then really amazing tax benefits. Garrett, talk about the tax benefits here, just in case people don't know what I'm talking about here.
Yeah, so real estate in general, and more specifically, multifamily real estate has what's called depreciation. So every piece of real estate has depreciation. It's typically it's over a 27 and a half year period is the way they calculate it. And it's part of the tax code. And it says that you can depreciate the asset over that period of time. Now, in single family rentals, you can take advantage of this. If you own them, that's fine, but it's going to be over 27 and a half years. And often it doesn't make sense to go and do what we do with multifamily, which is we take 30% of that, the personal property, and we push it into the first couple of years of ownership. And that's called bonus depreciation. And so what we're able to do is take that depreciation, speed it up using something called a cost segregation report, and then it's compliantly a way for you to get bigger tax benefits while you own a piece of real estate. Now, if you own a multifamily property outright and it's enough units, it probably makes sense to do this. Most people I know that have residential homes or portfolio, whatever, they don't actually take advantage of this because it's just the cost. It doesn't make sense. But we offer that actually to all the LPs. Anyone that partners with us, they get their share of that bonus depreciation, which if you're anyone out there that's got a job and you're not a real estate professional, you can take advantage of it as something that covers up any passive gains that you have. And I'm not a CPA, so don't check with your CPA for any of the advice that I'm giving you right now. But what you can do is if you have another rental out there, you have something that's producing passive income, you can take an investment into a syndication, use that to cover up your passive gain. Or if that's kicking off cash flow, it can cover that up. Now, if you're a real estate professional, like a realtor, or you spend at least 750 hours in the real estate space doing real estate related activity and your CPA agrees, that you qualify as something called a reps or real estate professional, then that same loss is going to cover up not just your passive gains, but it's going to cover up ordinary income and capital gains. So that's the boat that I'm in and Michael's in, and that is a really cool place to be because you can take these losses and help them offset the gains that you have. And as long as you have a pipeline of real estate, you can keep it going. Now, when you sell, obviously there's recapture and all that, of course, so it doesn't last forever. But if you keep a nice, healthy pipeline, you can keep it going. So it's a really cool thing. And now they're saying with Trump back in office, not to get political or anything like that, but they might bring back what's called 100% bonus depreciation, which existed a couple years ago. Right now, we're just at 40, and that's just basically where you take the majority of that 30% and move it into the first year. So as soon as you get into the investment, you can take the majority of that bonus depreciation. And so this whole thing is really a way that a lot of people out there just they don't end up paying taxes every year legally. The government, it's in the tax code, and it's there because it's there to help stimulate growth in an economy in certain ways. That's what taxes are there for. Is they have rules around them, and it's based on what the government wants people to do inside the country. And so it's a pretty cool advantage to owning real estate.
There's also something called a 1031 exchange, right? So if you have a house with a lot of equity in it, you may know about this. You can sell this and buy another house, another property, and then defer the tax gains. But typically what that does is it forces you to become an active investor. So you could sell that whatever house and buy something else, but you now own that house. But what we do, for example, in Nighthawk, we allow you to 1031 exchange into a syndication, which is really cool. It's a little more complicated, but we've done it several times now, and it's a way for you to actually defer your taxes from whatever house you have. And then on the back end, if you want to, you can 1031 exchange into another property if we have one. And this really allows you to defer taxes if you keep playing the game in perpetuity.
Yeah, I think that's it's really important to know that these tax benefits, they're there's something that really can make a big impact. I think taxes are your number one expense. I don't think that I know that. Everybody's taxes are the number one expense. I have a friend that's making a couple of $1 million a year uh, as a W-2, and he gives half it away to the government every year.
Wow.
And then you look at anyone that's figured this out that's in real estate, and it's almost like they're making double than because they're not having to pay the government in that year. They figured out ways that are creative to get around having to pay them in a legal way. And so it's a really cool thing that exists. And then not only that, you're getting the benefits of cash flow and appreciation in addition. So you have kind of all that going on at the same time, which is what makes real estate, especially in this format, such an attractive investment as an alternative. And again, like Michael said, don't make it your only thing. Don't put all your eggs in one basket, but diversify. Have the stocks, have the bonds. I'm curious. I know we talked about before, like why you guys are interested in real estate, but what is everybody else out there already invested in? If you can drop some of that in the chat, I'd love to know.
Yeah, what else are you investing in outside of stocks and bonds? That'd be interesting. Garrett, do you have any recommendations for 1031 a company or intermediary, or how one goes about finding one?
Yeah, so there's something called qualified intermediaries. So if we've had a lot of people reach out to us that they let's say they own a house and they're selling it and they want to 1031 that over. It's called a qualified intermediary. Uh, and those companies they're the companies that basically act as a facilitator to help you do the 1031 exchange. So you're going to be able the way it works, you sell your property, get your whatever funds that you get from the sale goes into an account with a qualified intermediary. They're going to hold those funds, and then you have 45 days to identify the next project. And then you have 6 months once you identify it to close on that. And the qualified intermediary, upon closing the deal, will take the funds that you put in with them and transfer it into the next closing. And that's how you can roll. And you don't owe capital gains on that transaction in that way. So you can, instead of paying the government, whatever the gains would be on that, you can roll everything into another deal and avoid that tax penalty, which is exactly how it works. As far as the actual QIs that exist out there, there's a few. You can look up ITEC is one. There's APX exchanges. You can Google them. There's a few out there that you can use for that type of thing.
I think if you have any questions, just email us at investors@nighthawkequity.com. That's investors@nighthawkequity.com. We help you to give you some recommendations. Now, Steve's asking a question before we move on it's basically about the difference between active and passive investing. He says, don't you make more money if you're not a passive investor and maybe an owner with some partners? The answer is yes. Yes, right? If you want to, for example, exit whatever you're doing right now and you want to do it in the next 1 to 2 years, you want to be a GP. Because it is more lucrative. But again, it's also work. So it really depends on what you want to do. A lot of our past investors don't really want to exit what they're doing right now because it's very lucrative and they actually kind of enjoy it. But they're trying to figure out how to diversify their capital. And it does over the course of 5 to 10 years, it actually does in fact replace their income over that time frame if that's invested wisely. So it really depends a little bit on what you're looking for. So let's pivot a little bit here. So we talked about, syndications, what they are, why you might want to consider investing in syndications. So let's talk about, okay, let's say you'll hop on nighthawkequity.com and there's a deal. We're like, woohoo, this is an awesome deal. Or you go on some other operator's website or you see an ad on Facebook and you're like, my gosh, how do I know if this is a good deal, right? And so let's talk about, Garrett, some of the how to do some due diligence on syndication. So let's just start. Where do you want to start with that?
Yeah. So how do you know if a deal is a good deal? Well, a lot of it is based on the numbers, but before you even get to that, you have to know what your buy box is. So I get deals all the time from brokers nonstop from all areas of the country. And that doesn't really serve me because I have to, 95% of those, I want to put in the dumpster. And so I have to know what area am I going to invest in? What is the size deal that I want? And then, what is the location inside of that submarket that I want? And so even though there's like, for example, we invest a lot in Atlanta, right? But there's areas of Atlanta I'll not touch. And so if I see a deal that comes through that says certain areas in Atlanta, I'm not going to go there. And what we'll do is we'll find a market. And this is what happens is you're going to see deals from all over. And it may take a minute for you to break into a market that you want to get into. But
Let me stop you real quick, Garrett,
yeah,
because I want to talk about, and we did talk about active investing for just a second. I'm talking about for passive investors, right? So passive investors are evaluating a deal from us or somebody else, and they're
oh,
trying to
sure.
figure out, should they passively invest? What are some of the considerations that you should think about?
Yeah. Thank you for clarifying that. So passively investing, if you're looking for how do you know if a good deal is a deal from an operator? So you want to first and foremost look at their track record. How long have they been doing this? Are they doing this full time? Is it something that is their career? Okay. And then what is their track record? Always ask operators, hey, can you give me a track record? Let me see what you guys have done. What kind of returns have you produced before? Do you have any deals that have gone sideways? Do you have any deals that you've lost to the bank? Like all these are questions that you need to ask anyone that's asking you for their money to do another deal. And then you have to do some research on that to see like, okay, what are they buying? What kind of products are they buying? If they're older properties that they're buying, you want to make sure that the operators have a really strong construction arm. Otherwise, they may not be able to execute on the business plan. If they're buying newer stuff, there's less of a need for construction. So that's something that you can also check into with the operator. And then you want to look at their assumptions. And the main things you want to look at are what are they what are they targeting as the amount that they can actually raise their rents in the market for the dollars that they spend? And that's a huge one. What is their expense ratio at? If it's lower than 50%, you typically want to check into that. It should never be below 40%. It's between 40 and 50. You want to look, hey, why is that the case? Generally, it's around 50%, okay, on their assumptions. And then the other big thing is the exit cap rate. So the reversion cap rate is the cap rate that they're saying when they exit the property, we think we can get this price, which is a big part of the guess that people are making when they get into these deals. And so you always want to err on the conservative side and you want to find operators that do the same. So generally, when someone has an exit cap rate that's lower than the market where it's at right now, you want to ask, okay, why do you think that that's the case? and then see if you agree with their assumptions on that. So a lot of these deals, they're 5-year deals or 7-year deals. Some are 3 years deals, but they're generally in that 5 to 7 year range. And so any operator is doing is they're making a projection outward as to what they think is going to happen with that property over that period of time. And a big part of if they can execute on that is going to go into their track record. And the other big thing that you want to look for is, are they spread out everywhere across the country, or are they kind of isolated to a few markets? And generally, the operators that are isolated to a few markets, there's less variables involved. So there's less risk involved in that, potentially. Now, if they already have assets in markets that are spread out, that's okay. But if they're going to brand new markets all the time, they have to relearn that entire market and who the renters are, what the good blocks are, all those things. So it heightens the risk of going into that investment. Does that
All right,
answer your
cool.
question, Michael?
Yeah, it does. Yeah. So two things really is you want to look at the sponsor itself and look at their experience and track record, and not just a track record of the individual sponsors, but them as a partnership, right? Because a lot of times there's joint venturing going on, and this is the first deal that this three partners or two partners have done. So really, what is their track record? And then with the deal, I think Garrett, you mentioned a lot of the good points. Look at their assumptions, like the cap rate, renovation timeline, rent growth assumptions, all those things. In general, here's the thing: you don't have to be an expert, okay? You just have to ask questions. I just find like a lot of people, all they do is they look at the returns and they compare one deal with another and look at the returns. But the truth is, Garrett and I can make our spreadsheet say anything we want. The truth is really, what are the assumptions underneath there? And so ask questions around the assumptions, and you don't have to know what the market cap rate is. You don't have to know what vacancy rates are in the market, right? You ask a question, why do you think this is a good projection? Does the answer make sense to you? You guys are competent people. You own businesses, you're professionals. Does the answer make sense to you? Or do you get the sense like the sponsor doesn't know or won't tell you or sounds aggressive or not very conservative? That's what I'm saying. So you don't have to be experts, but you have to ask questions and then see if it makes sense to you.
Yeah, they have to be transparent. So that's a really good point, Michael. It's transparency is going to be huge. In general, if you're asking them questions and they're just like dodgy with it, or you ask them the hard questions and they don't give you a straight answer, it's not a good sign. And so ask them the hard questions. Make sure that you have them written down, and then even if they, so what should happen is if you get asked the hard questions, they tell you the truth. Hey, yeah, we did have a deal that didn't work out, and this is why, and what happened. They don't hide it. There's just things like that that you have to look for. And then you can even, ask them to connect you with an investor that's worked with you before if you want to get deeper on it. But you're looking for people that have ethics, people that are really transparent in the process. What is their communication style like after you get into the deal? That's something you should ask. How often am I going to get updated? What does that look like so that you're going to be involved in just seeing what they're doing? Those are all really important things.
Yeah. Yeah, again, if you have any more questions around this stuff here, then hit us up at investors@nighthawkequity.com. But you can also go to nighthawkequity.com itself and scroll down, and there's actually a mini course on the bottom, and it's like 5 or 6 videos that kind of explains the whole thing of syndications. So if you want to learn a little bit more past this webinar, hopefully we'll do a good job of giving you a pretty good introduction. It's a great way to learn more about syndications as well. And let's talk a little bit about the market outlook, because some people are asking, my gosh, what's going on right now in this market? What is the outlook for multifamily? Where should we start with that, Garrett? Good time to invest? Should people wait maybe?
Yeah, so we saw a defined peak in the market, which was March of 2022. And so that was very clear. That's what I like where we're at right now in the market cycle when it comes to purchasing, because we saw things peak out. And ever since that peak, things have come down as far as pricing goes. There's a big thing that happened recently, which is interest rates shot up faster than they ever have in history. And because of that, it's impacted pricing because a lot of commercial real estate, or all commercial real estate pretty much, is based on yield. These are investments that people are buying to some degree. And the residential markets maybe didn't get hit as hard because there was a supply shortage and all that stuff. But in commercial, you saw pricing reduce 30, 40, 50% from the peak of market. And so that to me screams, hey, this is a great time to get in. Now, existing deals that have been there, their values went down also. So people that were in deals before may be feeling it a bit right now. But right now is really one of the best times to get in if there are deals to be had. And so it's a lot harder for operators like us to find deals because they have to pencil right and they have to meet where the market volatility is in order for it to make sense. But if they are offering something and everything checks out, it is generally a very good time, in my opinion, to get in just because of what we've seen so far inside of the market.
Yeah, it's the other thing that's different now than say 2.5 years ago is the interest rate outlook is completely different. And 2.5 years ago, everybody knew interest rates were going up because they were basically essentially at zero. We were getting free money. So everybody knew that we can't go any lower. Well, unless maybe we're in Japan, but they were going up. And that, of course, is bearish because as interest rates go up, prices will have to come down because of the cost of capital. So everybody knew we were towards the height of the market. We didn't know where exactly we were. But now the consensus is interest rates are flat to down. That's a different market outlook entirely. Also, 2.5 years ago, we were getting very high leverage. We're getting 80% of everything, 80% of the purchase price, closing costs, construction. Now we're getting 75% of the purchase price. Like that's it. So the leverage we're using right now that we have available is much, much lower. So you're always looking at the risk, right? So if you're looking at the risk spectrum, we're at the completely other end of that risk spectrum than we were 2.5 years ago. And that's kind of where we are right now. So as Garrett is saying, we do think it kind of reminds me a little like 2008 in two ways. One is people are a bit afraid because stuff happened and maybe you watch the news and you're like, oh gosh, this is bad. But the sophisticated investor, of which you are, of course, you're looking for the opportunity. Like Warren Buffett is like, I don't know, there's blood in the street. I think I got to figure out how I can get into this opportunity, and that's kind of what it feels like to me right now. So it's difficult from an emotional perspective to try to invest, but now is really the best time to invest. Our biggest challenge right now is finding enough deals and raising enough capital. But we'd love to buy as much as we can. I suspect that the deals we buy over the next 12 to 18 months are probably the most profitable we've done in maybe ever.
Yeah, it's really exciting to see what's out there, and you're looking at these price sheets, and you're like, send me the comps from a few years ago, and they're just this pricing was sky high in the same area compared to what it was. There's other factors also that have brought the prices down, like the inflation on your expense on any expenses that you have. So like insurance, your payroll, even your tax bills, things like that have pushed that up quite a bit. And so there's pressure in that direction that's helped bring pricing down. In addition, there's been a big oversupply issue inside the market where there's a lot of units being delivered right now that were developed when interest rates were nothing, essentially. And all of that is stopped. So the deliveries are hitting, but the new starts have stopped. And so you're going to see a recovery most likely on the rent side because there's still really a demand. There's a big gap between what people can afford to buy a house and rent. There's still a huge gap there. So there's still a huge demand to rent. So once this oversupply calms down, you're going to see the rents continue to go back up, where in this period of time, they've fallen a little flat or even gone down. And that just helps with pricing. So it's like all these factors at the same time hitting at once, driving pricing down. What better time to get in? You want to buy low and sell high.
Yeah, so like I said, if you want to find out more about syndications investing passively, check us out at nighthawkequity.com. You're also welcome to email us at investors@nighthawkequity.com. We have free resources on Nighthawk, and you can also join our investment club, and that way you'll be notified first if there's an upcoming opportunity. We're closing out one right now, as a matter of fact, but Garrett and the team, we're constantly looking for new opportunities. So thanks so much for your time here, being on here, and we'll hope to connect with you later.